Asia has been managing its exchange rate. So just to illustrate my point, I just picked Brazil and China, mere coincidence. What I used here in this graph, I hope you probably cannot see everything, but just combine two of the methods. What is the blue line is the PPP, it's the ratio of the market exchange rate to the PPP exchange rate, and the red line, or the pink line, is the current account balance. That's both for Brazil and China. And I just want to draw attention to the fact, in the case of Brazil, what you see is they're all below what would be the PPP exchange rate. I mean, as I said, there's problems with the PPP because the services, the benchmark is the U.S. The U.S. has a lot of more service in its economy. So, but what I want to highlight here is the fact that in the case of Brazil, you see there's a sort of a negative correlation with certain lag between the exchange rate, the real exchange rate, and the trade balance, something that one would expect. And there's a lot of volatility as well. In the case of China, it's much more stable at a level which is below the PPP level that Brazil has, and there's no clear correlation between the exchange rate and the balance, the current account balance. You see some of that after 2005, China began to allow the renminbi to appreciate gradually, but still there's a huge, China was accumulating a huge current account balance. It went up to 10% of the GDP, and still you have a very mild appreciation of the exchange rate. So I think it's not just China, as I'll show you right there. It's the same sort of argument. This is from a paper from the Asian Development Bank paper. So it's sort of a neutral kind of source. And they look at, they use a Franken-Way method to measure what type of exchange regime those countries are using. And to cut the story short, if you have the index equal to 1, it means that you have almost a complete peg to the dollar. The lower the index you have, the more flexible is your exchange regime. And as you can see, it's Hong Kong and China lead the pack, and then you have Malaysia, you have Taiwan, you have Vietnam. India with a more flexible exchange rate, particularly from 2005, from 2005 onwards. But there's a clear issue there that Asia somehow managed to peg its exchange rate to the dollar and managed to keep it stable at a very low level. And there's also an issue here of strategic interactions. If China does that, if Taiwan does that, everybody else wants to do that. Nobody wants to have a more devalued exchange rate than its close neighbor. So there's clearly an issue of coordination there. But I think this, again, it's not just China. I think it's an Asia issue. So what is behind this misalignment? I think Mauricio already talked about that, but it's clearly systematic intervention by central bank to keep the real value of the local currency relatively low and stable, coupled by efforts to neutralize the impact of this intervention in the inflation, what we call sterilization. So it's the same. It looks like the same sort of thing that the central bank is doing here in Brazil, but they are much more successful in doing that than we do. And so what is? But there's, I think, a fundamental difference between the two policies. They are both intervening in the exchange rate market, but in the case of Brazil, which has inflation targeting regime, or at least one would hope that would be that way, the central bank is intervening to try to reduce volatility. It doesn't want to have very sharp movements in the exchange rate because of the impacts are huge on the real side of the economy. So it's not trying to change direction, but just try to reduce volatility. So to use the economists talk, I mean, the central bank in Brazil, it leans against the wind when the wind is too strong. The problem with Asia, they're always leaning against the wind. So it's not exactly the same thing. So how do they, Asian countries in general manage to avoid the inflationary effects of exchange rate targeting? Which is saying it's even with sterilization, I mean, we can see, here in Brazil, we see in Argentina, it's very hard to prevent, it's very hard to keep control of monetary policy once you start to try to sterilize, the intervention in the exchange market. So my hunch here is that it has to do with capital controls. Again, I mean, there's no doubt that the type of capital controls you find in India, you find in China, in other Asian countries is much harsher than we practice. It's not just a tax. It's much more complex than that. But this is coupled with what I call here financial repression. I mean, they managed to keep interest rates very low. In some of those countries, most banks are in the state hands, so they push, the government managed to push some of the costs of sterilizing the exchange rate to the banks and, of course, to the savers. And they also couple that with fiscal discipline. So this is something that, we can have it here, and I'll talk a little bit about that, because our capital controls are much weaker, and I don't believe on them anyway in the medium to long term. And our financial markets not repressed. I mean, we can control interest rate, we can force banks to buy government bonds for whatever the price we want, and we have a much more poorer record in terms of keeping fiscal discipline. So my point here is that is it this kind of arrangement sustainable, or if there's a number of economists that argue that everybody should do that. I mean, if the Asians are doing, why not we also target the exchange rate, and then we could also be very competitive. But before. I just want to look at this question. Was exchange rate target successful in boosting growth in Asia? I think there's also debate about that. Some economists argue that, look, in the long term, money is neutral. There's no impact on growth at all. I don't agree with that. I mean, I'm more heterodox in this sense. I think that there was an impact. In the case of Asia, I think they were very successful in doing that. I don't think this is the main explanation for Asia, for China, for Korea, for other to be so successful. Perhaps it's 10% of the explanation. You have to look at savings, you have to look at productivity. So there's other fundamental factors beyond exchange rate. But I think exchange rate definitely helped them in terms of expanding the exports and growing faster. And perhaps for the reasons that Daniel Hardwick has a paper where he argues that devalued exchange rates can help growth. So because it channels resources to higher productivity sectors, tradable sectors. So I tend to agree with that. But then there's an issue with that, which is doesn't that kind of practice or exchange regime, doesn't it hurt other trade partners? I mean, I have no doubt that there's an issue there. There's the beggar-tie-neighbor type of policy, and once you devalue exchange rate and your trade partners don't, you are becoming more competitive, you're going to win market share, so you're going to be hurting the other partners. I don't think that this was very much an issue in the 70s, in the 80s. I mean, Asia didn't start to target exchange rates, in 2000. This is something that goes on since the 60s. So why people didn't pay that much attention? Because the countries that were industrializing were relatively small. We're talking about Taiwan, we're talking about Korea, we're talking about Indonesia, even Japan. It was 100 million people. Wasn't that? I mean, But now, when you get an economy of the size of China, when you get an economy of the size of India, then, you know, it can go unnoticed. And you're going to have people getting hurt. You're going to have people talking about it. So, and that's another factor is that in the 70s and the 80s, we Brazilians, you know, the rest of Latin America have very closed economies. So we didn't care much about, you know, our share in international trade. So for us, wasn't that a big of an issue because, you know, tariffs were 200%, import licenses. So this also has changed. So now we have a much bigger tiger, much bigger tigers, dragons, tigers, and now we have an open economy in Latin America. So it's bound to hurt. So this, then there's an issue of you can have all no, it hurts. It is successful for Asia. Then the last question: should all EC countries, emerging countries, target the exchange rate as well? I mean, this is clearly you know, a fallacy of composition. So if you all target the exchange rate, if you all want to have, you know, the value exchange rate, we're not going to have that. I mean, it's impossible. It's, you know, it's a relative concept. So there's the problem of fallacy of composition. We're all going to be spending a lot of money, and there's going to be huge distortions that, you know, I'm certain the countries like Brazil and other countries don't want to have. We don't want to have a financial repressed financial system just to make the cost of sterilization lower, because this is going to have other impacts in terms of allocation of the resources. And I don't also think this is politically feasible. You know? People are going to ask questions, why savers and taxpayers should be subsidizing exports forever? So there's an issue there that I don't think that's going to work. So if we can all do that, you know, we need to do something to regulate that. That's I think the conclusion that I reached. But before talking about the issue of regulation, before talking about regulation, there's this issue of the exchange rate targeting. Is just one of the issues that we need to talk about if we want to make sure that emerging countries can keep benefiting from trade. So, and I'll talk very briefly about industrial policies, but it's also an elephant in the room. It's not just the exchange rate. I mean, I mean, Asia in general has been, again, it's not just China, it's not just a recent issue, it's something that they have been doing since the 1960s. And they have been very successful in doing that. And again, just like with the exchange rate issue, there is the problem that this also hurts all the trade partners. So, again, the same kind of thing. Can we replicate that? I'm very skeptical that we could do that in a country like Brazil. We tried many times, you know, some success here and there, but on the whole, we had huge problems. I mean, just to think of, you know, the problems that we had in the 80s, you know, with inflation, with totally lack of control of fiscal policy, the fact that we can't target sectors, we start